and disclaimer, and we'll be ready to go. Mr. Computer, please.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither Philstock World, Com, PSW, nor its affiliates, nor any of the respective offices, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media are identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. So we got that going with Mark Zuckerberg. All right, first things first. Getting over a little summer cold thing. Yes. So, it's 1 o'clock now. We can look at this one. This is the EIA today. That's not today. Son of a bitch. What's wrong with this? May 16th, May 9th. All right, hopefully this is better. Oh, April 27th. That is not the right date. Isn't that weird? Now it says May 4th. All right. So we have a, well, first of all, let's look at the damages. Oh, shoot. Oh, this thing must have rebooted. I don't have Thinkorswim up. Uh-oh. Hang on. I'm going to have to pause the screen sharing for a moment so I can put Thinkorswim back up. Let me see. Yep. Be right back. It's one of those things where it's taking time too. Sometimes Thinkorswim comes right up, and sometimes it takes a while to do updates and whatever crap it's doing. All right, let's see. Initializing, creating. Should have checked that earlier, but I didn't think about it. Well, what is that? Oh, there we go. Now it looks better. All right, we're back in business. Holy cow, look at them go. We're having a certified breakout on the indexes, that's for sure. It's funny because we made our money on the morning dip, and thank God we took it because it came right back up. Now we broke now we broke over our shorting line. We can't play it short. We actually could more likely play it long at this point, but we're going to look at oil. It's more important. How long is this going to take to draw itself? Oh no, that's the wrong chart. I wonder. And, that's not so bad. One of these. Okay. So first we want to see if anybody's got a significant thing. So Brent's got it hitting a line up here. and it's 77. I would say 77.50 is probably the stopping point there, and that seems to be lining up with 71.50. So it's about $6 ahead for oil. Now we had a run from 74 to 77.50, so that's 3.50. So a week retrace off of this run would be 70 cents. So we're going to look for a 70-cent pullback from 77.50. And even though 77.41 was where it hit, we assumed 77.50 was the line. So if we have a 3.50 run, we're going to get a 70-cent pullback. So that's going to be 76.80 is going to be the target here. And it'll be basically the same 70-cent pullback, a little bit less from 71.50. And we call that 70.80. So that's going to be a weak retracement to this. You could actually play it because really from 71.20 to 70.80 is 40 cents. That's $400 in oil. But you know, it's got a lot of strength. So there's no particular reason to play it unless we find something interesting in the report that we didn't see so far. Because the report just came out, so people haven't seen it yet. So let's see what the report says. We know there's a huge draw. Oil down 2.2 million barrels. Gasoline down 2.2 million barrels. And distillate down 3.8. So 3.8468, 8.2 million barrel overall draw is a huge draw. Because usually there's some kind of offset. There's no offset here at all. There is, however, a I'm sorry. Here's where the scam is. There is a 6.6 million barrel build in other oils. And this is how they screw around with things. Because they have this category that's not reported. And because it's not reported, they can pretend there was a huge draw by they recategorize their oil, basically. I mean, all other oils, you know, and there are obviously legitimately other kinds of oils. And I think, frankly, I think avgas might be another oil, not a distillate, you know, for aviation fuel. But the bottom line is they're not really showing the truth, because the truth is total U.S. commercial inventory went from 1852 to 18497. So it's really a 2.3 million barrel net draw, not 8.2 million barrels as you're being told. That's a pretty big difference. All right, and we're also still exporting a crap load of oil. We're exporting 3 million barrels a day. It's actually down a bit, but we're still exporting 3 million barrels a day, 21 million barrels a week of oil we're shipping out. How much oil do we use in a day? 20 million barrels total. So 15% of our daily consumption is being shipped out of the country. We're not consuming it. We're not causing this drawdown. The exporters are causing the drawdown. But still, you know, look, it's kind of meaningless in the grand scheme of things. The bottom line is that they're going to react to what they react to. They react to the headlines. But if you want to make money, you got to be smarter than the headlines. So these headlines are telling us that we really shouldn't expect them to go much higher than this. Certainly not past 72. This red line up here is almost certainly not going to get past. So let's say this Brent stays under 77.25. Then let's play oil short at 71.20 and look for that 40 cents, right? So we'll go to trade, active trader. We'll move to CL. Hunter. No, what is that? CL. There. And we're going to take a short. I'm a little late, but I'll take the one short here and see what happens. So I'm in at 71.17. If I want to do another one, I'd have to wait until 23 so that I could average 20, which was my intention. But at the moment, I'm in at 71.17. For demonstration purposes, I just jump in on things. When I'm trading myself, I never do shit like that. It's a terrible thing to do. Now, if oil is topping out here, then the indexes are probably topping out here. And look at the Dow. The Dow's right at, just under 500. It can easily backtrack a bit, so I like a short on the Dow too. So let's take a look at that. Well, let it go up though if it's going up. The closer it gets, the more comfortable I am with the short. So I'm pretty happy. We're looking at the Dow short. I should really look at the S&P. Let me flip to the S&P over here just to make sure. Maybe it's a better short. I doubt it. No, it's not. See, the S&P busted through that top line. That's a little scary, but I'll take a chance on the Dow here because really it's only going to go up like 20 points or so before it runs it. If it goes up 20 points, I feel real comfortable doubling down at the 24.5 line because that was a good short before. See how I touched 24.5 exactly before pulling back? So at 24.5, I would certainly give it another try and double down. That'll average me up at about 24.490, and I'm sure I'll get a pullback there to average me in. So we'll see what happens. So I got the one short on the Dow at the moment, and I've got the one short on oil. Oops, you can't see it now. And what we want to see to confirm is we don't want the NASDAQ going above 75 again. And we certainly don't want the Russell breaking over 1600. The closer to 1600 the Russell gets, the more I want to short that too. And here's EL, here's CL. So that's two shorts we have so far. Oh, remember 23? I said I was going to double down. Not getting there. Remember, we're only looking for a pullback to 80, and 71 might hold, so we might have to take a quick $200 and run or whatever. Don't get too excited. 150 the way I entered. We're only expecting a pullback. And by the way, here's the point. The pullback is from this run. Okay, so you had a run from 69. You had a run from 68.50 to 71.50. In this case, it's $3. So a 60-cent pullback from 71.50 would be 90. Would be 70.90. So that's what you're looking for here. It's proportionally 10% smaller of a move in each direction than the Brent is. Oh, here we go. Nice move on the Dow now, getting down a little bit. So because now look, so what do we see? We see very large run-ups, and then we say, what's it about? Well, it's been running up since 10:30, so it's all about oil. And so I want to say, if oil is topping out, then the market's probably topping out. See, I'm just following a chain of logic. How do I know if oil's topping out? I go to the oil report and I look for bullshit. And what's the bullshit? The bullshit is that they don't report all other oils had a build of 6.6 million barrels. That's a pretty major omission if you're going to report the oil inventory. It's part of the inventory. Here's the inventory report. Here's the category, all other oil. There's, the SPR doesn't do anything, so they're not talking about that. All other oil had a significant move, a huge build. But nobody's going to say a word about it because it's not the narrative they want you swallowing. They want you swallowing the market bullish, everything's great, la, 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 bullshit strategy. Just like this morning when I said it was all going to fade out once we start trading. That's what happened. And then they got another chance to push the markets up when oil came out because the oil stocks all jumped up because they think this is going to go to the roof. But it's not, because really it makes no difference if we've done the sanction thing with Iran before. It didn't make oil go up any. It's all very silly. But anyway, so we'll see how it goes. And I should pay attention to this one because it could go quickly the wrong way on me. All right. Spicoli says, Mr. Spicoli, it's time to bail on HMNY. Is it time to bail on HMNY? I don't see why. It's a wonderful little stock. Let's take a look. All right, so far we're up 45 bucks on the Dow. We're down 10 bucks on oil. Look at that one. The assets coming down much faster. All right, well, gotta be patient. Oh, here we go. $100. Yes. Oh, 45 bucks. Wow. You know what? When you see $100 turn into 45 bucks that fast, you probably want to take $100. 80. Next time you see 100, you might want to take it. Come on, 95, 100. I'm putting a stop here now. Oh, here we go. Now I feel better. Oh no, wait, 105. Sorry. Oh, 55. Bastard. I knew it. 75. No, this is too stupid. So let's take that money. 90. If I wish I had two, because then I'd leave one, but I don't. 90. Come on, Phil, don't be greedy. 85, 95. Watch, as soon as I take it, it's going to drop like a rock. 100. All right. Take it. All right, done. So $95 it ended up being. All right, that's okay. We made a quick 95. We'll take a look later. If it was moving down normally, I would have stuck with it, but it was the way it jerked back up, it gave me like very little faith that this thing will keep following through. And meanwhile, we've also got the oil contract down, which was our primary premise, was that we'll make money on the oil contract. So let's see how that goes. All right, I did not like the way that jumped. When you can lose half of your gains in a second, that means you can go. That means from the half you're at, you can go negative in a second too, right? So what's the point? Make $100 in 5 minutes. Take the money. All right, so that's good. And oil's going okay. So we'll see how this is where I want to see what happens though. Remember, we're only expecting a small pullback here. That would be. I'm sorry. We expect at least a small pullback. So a weak retrace to 69. That's to 70.90. Would be a weak retracement of the run it's had so far. But if that fails, the next line is another 60 cents below that. So you can go all the way down to 670.30. But that doesn't seem likely because look how 70.50 held up. So that's actually a pretty good sign that, and since 70.90 is right near this line, there's a good chance 70 is going to hold. So I think we should probably take 70 and be happy, and that's going to be roughly $150 profit on that one. Now, meanwhile, if the Dow pops up enough, if everybody pops up enough and then looks weak again, I'm happy to short again. I might even short the NASDAQ this time because I think they had a better move down. But really, you just want to short whoever's closer to your goal is the one you should be shorting. Whichever one is closer to your top side goal, that's the one you want to jump short on. You don't be, don't play favorites. It's not worth it. You just got to look and see who's going to hit the most resistance. Who's got the best wall behind you to stop you out. So anyway, I got sidetracked, but we were talking about. So I had a premise. I said, well, here's the problem. There is something wrong with this report that people aren't reading. And the 1 p.m. report just came out, and because we're able to interpret it, we have an advantage over the people who don't even know what this is. You guys probably never heard of this crap before I started talking about it. Nobody looks at these things. They take whatever the TV people say at face value, and they give you like the barest skim of what's really going on. So oil's jumpy too. So that's, and again, another reason to take your profit here, because now I don't mind losing $10 here. But oil is jumpy too. So this whole thing is not working out at the moment. Doesn't mean I'm wrong. Just means it's not working out at the moment. 70. Where did we come in before? Was it 73? I don't remember. 76. It was like 77, wasn't it? But I don't want to jump back in. If oil's not weak, then there's no point. But I did say I want to add another oil short at 23. And I do feel good about that. The NYMEX closes at 230, and I'll be surprised if people don't want to take profits off the table. So I'm going to add another contract here at 23 and see what happens. But then into 230, there could be a spike up. It's a problem because there could be a spike up into the close. But I kind of think that they're probably going to take profits because this was a hell of a move from yesterday. I mean, you're making $3,000 a contract on this move from yesterday. You got to want to take some profits. These guys don't have one contract. These are these are guys who've got millions, 10 million, 30 million, 50 million, $100 million gains. You're not going to take some off the table? That's crazy. They can lose money another day, but there's no need. If they can get this kind of money, why not take it? Oh, look, it came right back to 40 too. Wow. I'm sorry, not 40, 80. My eyes are getting worse. I'm making more and more visual mistakes. I'm not happy about that. It's not cool getting old. All right, so Harmony and green coin. Let's see. All right, it's two things to talk about besides this. All right, well, just wait and see what happens with oil. I'm not going to be too concerned about it. Here's 85, 84, 70. Oh, here's that 75 test, though. See, I can't get away from this one because it's too interesting. Up 98 point. Remember I said this would be my favorite if it comes up to 16. 98.1, 74. Who's going to make it first? Who's going to get another point? Come on. Nope, he's failing. 74.5. Come on, 75. Come on, right there. Oh, come on. You want to start shorting wherever you have the best backstop. The 1600 line is a huge backstop that a backstop meaning the Russell's not very likely to pounce over 1600. So that means that if you short just below 1600, you can use it as a stop, and it's not likely to blow past your stop line. So you can't get hurt too much. The most important thing about entering a trade in the future is that you make sure you can't lose too much money. And once you knock that out, the rest is just gravy. So oil has stopped going up. That was driving the market. The markets are starting to weaken, and I'm not getting a better price, unfortunately, for the re-entry. So let's give it a few minutes and see what happens. Because I'm still not, I'm not making money. I don't have enough. I could get right back in where we started, but I don't like the way oil is holding up so far. So it's not really, I need my premise to be working completely, not partially. So what do we talk about? Harmony, right? Harmony and me, pretty good company. Where are we at? 92 cents. Oh my God. Oh shit. We just added to it, frankly. Completely getting crushed, though. I mean, just absolutely murdered. People are running from this stock like it's on fire. At this point, I mean, yeah, we can still lose another $5,000 or so, but I mean, I'd rather lose it than get out now. Look, there's some simple math to the thing. They are burning $20 million a month. To be successful, they need new subscribers. So if they get more subscribers, they'll lose more money. Kind of like Tesla. The more cars they sell, the more money they lose. Somebody's got to believe in what they're doing for this to work. Now, I thought people did believe in it, and kind of, Verizon owned MoviePhone. They just traded MoviePhone for 10% of Helios's stock, which was theoretically $20 million at the time. At $2 a share, Verizon made this trade here and gave it a value there. So they gave them MoviePhone. MoviePhone's a real company that makes money, and Helios owns that now. The way they intend to make money is not on the subscriptions, obviously, to MoviePass, but on selling the analytical data from having 5 million, 10 million people signed up, by having and 10 million hardcore movie fans, not like users, obviously. That's what's killing them, though, is they're signing up all these hardcore movie people who go 4 or 5 times a week to the movies. It's a problem, and they're going to burn through probably $500 million worth of cash before they get to the model where they wanted to. That was their plan. Of course, when your plan is to lose $500 million, it's very easy to pick holes in the concept, especially when you have not yet raised the $500 million you intend to lose. They thought that they were going to be able to sell a big chunk of stock and get $100 million to get them through to next year. They thought that they would have at least a $400 million valuation, and they dilute the stock maybe a bit and sell some stock. Excuse me, that's not happening now. Now the stock has no value. They got nothing to deal with. This is a problem. Now, Verizon took warrants at $250 a share. Warrants to buy another 10% of the company, basically. I don't think they did that for no reason. I think they looked at the numbers and they looked at the plan, and Verizon thinks they can pull it off. So I think Verizon, who are going to have a big interest in this thing, are very possibly going to come in with a good chunk of money for the company. They might take half the stock right now, but if they do, then they're going to keep funding it, and that'd be great. So I don't mind being diluted if Verizon is my sugar daddy. There are other people who might step in also, because they're really not doing worse things than Open Table did when they started, or somebody like that, or Grubhub. All these people lost a ton of money. Like, all these delivery companies lost a fortune, because until you have a volume of delivery, you lose money, because you're delivering to half as many places with the same amount of expenses, same driver and the same this, same that. If they're not delivering 2 meals, they're delivering 1 meal, and then you're making much less money. So your overhead's the same, but you're not delivering as much. I mean, now the Grubhub guys around my neighborhood now, they deliver too much. They got like 4 meals per trip in their car, and so if you're either lucky and you get it first, or you're unlucky and get it last, and then you get your food all cold and mushy. And the problem for the restaurants, and I talked to my Chinese guy, stopped dealing with them, because he was telling me, he said, I got too many complaints about the food. He goes, my drivers, when I send them, we send the driver straight to someone's house. They drop the food off. It's fresh. It's as fresh practically as if I delivered it from the kitchen to your table. This guy cares about the quality. He's like, look, when I deliver, when someone calls us for delivery, we've got a driver waiting, and the second the order's ready, he takes it and he leaves. And it is like magic. I mean, literally, in the Chinese place by my house, it's like a joke in the neighborhood, because literally you place an order there and you hang up the phone for delivery, and if you get distracted for a minute, like you start having a little conversation about something, the doorbell rings and the guy's there, and you're like, what the hell? It literally seems like it's like less than 5 minutes since you called them, and they show up with the food. You can't even imagine they had time to cook it. In reality, I think it's about 15 minutes. I mean, they beat Domino's by a mile. I mean, I don't know how. I imagine they pre-cook a lot of stuff that they know is popular, but it's just an amazing operation. Anyhow, so that being aside, but the guy said, look, the problem with Grubhub, he started dealing with Grubhub, and he said, he goes, I never got complaints before, and he says, these are my customers. He goes, I don't want them to ever think I would serve food like that. He says, we never would. He goes, that's why we're so, that's why we're so popular for delivery, because we deliver the same as if you come to the restaurant. So where do we go? I totally lost track. Helios, right? So the thing is, a lot of companies have a plan to lose money when they start. Helios had this plan. What they failed to do was have the investors line up who were willing to lose the money with them. And effectively what happened is, when the fact of the losses came in, well, I'm sorry, they did at some point. If you go back a bit, when they first announced what they were doing, people said, this is a fantastic idea, and everybody jumped into the stock and brought it up to $38. But now that they're actually doing what they said they would do, nobody wants to be in it. But this is not the first time this has happened. Look at this. All right? It looked very hopeless here, and then it shot up to 17. And then it started looking like it was falling apart. Then it shot up to 38. It's an interesting pattern, right? Because it goes all the way down, double, 17, all the way down, double where it was before. If it goes all the way down here, we should hit, on this track, we should hit 70, I think, on the start. We're not looking for that. We're looking for it to get over $2. Frankly, I think it's worth a toss at 93, just as like if they get saved. Now, sorry, it's going to be 93, and then if somebody comes in and dilutes you to hell, you got to buy in and stop yourself from being diluted out. So if it goes from 93 to 50 because somebody comes in and puts a lot of cash down and they dilute the stock, you got to buy more. You can't let yourself get diluted and then just sit there. When the stock gets cheaper to reflect the dilution, you need to lower your cost basis by adding stock. That's it's kind of the whole point. Meanwhile, I think their overall plan is good and workable. Conceptually, what they want to do is they want to have 10 million people using MoviePass, paying them $100 million a month. So they'll have the billion something in incoming revenue. At that point, and they're not at that point now. The other thing that freaked everyone out with MoviePass, AMC in their conference call 2 days ago said, "Oh, yeah, we kind of like MoviePass now." They had been having fights with MoviePass. They go, "We kind of like them now because their customers paid us an average of $12 a ticket, $12 a ticket, and we've sold hundreds and thousands of tickets to MoviePass customers last month." So, the largest theater chain in America, had hundreds of thousands of people use MoviePass to see their thing. Obviously, that's what MoviePass wants, right? But $12 is kind of scary because you're only paying MoviePass $10 a month. So that means they're losing $2 per customer, even if they only see one movie. They see 2 or 3 movies, and MoviePass is doomed. So that's the problem that they're facing. The point is, MoviePass thinks that 10 million users will bring in. Okay, here's a good example. Let's look at Twitter for a second. So TWTR. So Twitter, for example, has 200 million users, and they make $2.5 billion. Okay, so they make 200 million, 2.5 billion. So they make $10 per user in profit. So that's just on advertising. So what Helios is trying to do is they're saying if we have 10 million users and we make $10 a user on advertising, that's $100 million. I'm sorry, it's $1 billion. Sorry, it's it's 100. No, it's per month. Yeah, so they'll make about a bit. They'll make whatever. They'll make 100 million plus on the users, like 10 million a month on the users. Plus, they're going to sell the analytics and the data. Plus, because they have 10 million people going to AMC or whatever, they're going to be able to. Then they're going to say, "Look, we're going to stop sending you our people if you don't give us a discount," and then they can knock the prices down and save some money. So they're going to sell the advertising, they're going to sell the analytics, they're going to get kickbacks from the movie theaters for sending people. They do that. They do that now. They've demonstrated they're able to send people to specific movies and fill up the theaters for specific movies. They also have a plan to invest in movies. And it's the same concept Netflix has. It's like, hey, we have the analytical data to say we know what our audience wants to see. So we're going to make a movie our audience wants to see. And then we're going to send our audience to that movie and fill up the theaters with people because they already paid for it. We're going to encourage them to go. It's a great plan, but it has to get the wheels spinning so they can gain some traction. And until then, they're going to lose a boatload of money. So the question is, will they find investors who want to do it? Now, Tesla found investors who want to do it. SolarCity found investors who want to do it. Now it's part of Tesla because they ran out of investors who wanted to do it. Amazon has been doing it for years, losing a fortune. You got to find those kind of people. Netflix lost a fortune. Okay, the thing here is these people are bailing, but they bailed here and they, what were my mouse? They bailed here and they bailed here, and now they're bailing here. So if it pops back up again, because all they have to do is find one guy who believes in them, and gives them a ton of money, and up they'll go again. Excuse me, I'm getting some water. All right. So hopefully that answers that a little bit. So Greencoin stopped trading on one of the exchanges, and now the coin market cap thing stopped reporting them and reported a huge dip, and then people complained about it and said that's wrong and blah blah blah, and so now they just stopped reporting them completely, so it's stuck at this incredibly low number. It's just, I mean, it's not something you really want to pay attention to at the moment, but it's going to go up and down and fluctuate. But that's why I said when it was up, that's why when it was up the other day or last week or 2 weeks ago, whatever, I was like, you got to sell some. When it goes up, if you can get that kind of price, you got to take it. And you never chase them because they're crazy when you chase them. Oh, futures have popped over my lines. Anyway, so at the moment it's in flux. I'm going to talk to Chris and find out what's going on, if he can give you some insight, but we'll see. But as far as I can tell, what I understand happened is it stopped trading on one of the exchanges. That threw off all the coin market caps thing for analyzing it, and it showed it like it plunged to hell. So we'll see what happens. Hang on a second. Futures. Did oil go up? Ooh, okay. So okay. I can still live with this. 25.5 too high. 26.96, so 27 is a good spot to short there. 68.85, but at 15.98.99. So I like the Russell short. I still like oil short because of what I know. So let's see what we can do. With oil, I'm going to be happy to add one here to get my number up. So we're going to short. Don't forget, I knew, we said it was going to probably run up into the NYMEX close, so we'll see what happens. I mean, it could run up into the NYMEX close. I'm hoping it sells off in the NYMEX close for the profit taking. So now what? How did that happen? The second I did it. And the Russell I like for short up here. I'm not gonna quibble over a penny. Whoa. Here you go. So I'm gonna go too short there. So that's 15.99.30 on the Russell. Because again, if it's over 1,600 for sure, we're gonna get out. Oil, I'm willing to stick with because I see that report and I'm saying this is bullshit. It should not be this high based on that report. But this one, look, 99.60. So I'm hoping it stays under this bar right here, under 16. And that, but you want to mark whenever you get in. You want to mark where everyone else is. So he's at 85 and he's at 511. So if they keep going up, then you say, well, then you got to have an itchy trigger finger to get out of the trade. Oh, I'm sorry. I forgot I already played this today. I was already up $500 on the Russell. But anyway, so all right, let's say we were already up $500. So minus 500 on that for whatever we're doing now. Now, since I added one, I dollar cost average it here. If I get a chance, I want to cut back so that I'm even at 71.21. So if we do get a little pullback, we'll get it. But okay, that's not bad. So nothing bad happening. It's just pushing and trying to get higher, but it's not really working out that well. FTR, Citibank lowered their thing, cut it to sell. Screw them. I mean, I don't see it. I don't know what. I didn't read the report on the. I didn't. That's just a news saying they did it. I want to read the report, seeing what the analyst actually said and what his reasoning is. I don't see it. I think they did. They had a great thing. I'm not sure. It did affect them quite a bit. Well, yeah, of course, they put a sell from Citibank, but Citibank, they'd be bankrupt if they weren't rescued. It's so stupid. It's like, what do they actually know? Look at that knockdown, man, down to $9. That's so uncool. But they were already selling off, so it's like there's been a lot of pressure on them. But they had a very nice run. And as I pointed out to the members today, we sold the $8. We bought the stock. We sold the puts and the calls at $8. So our target is $8 in 2020. So to sit there and worry about like the day-to-day fluctuations now makes no sense. I mean, that's our target is 8. So as long as it doesn't go into 8, I'm okay. And Citibank's target for this year is like $7. So I don't even care if it goes to 7. In fact, if it does go to 7, I might buy those $8 calls back because I think they can do a lot better. After the last earnings report that I read, and unless he read something way different than I did, I thought they looked pretty good. Calvin did miss. Wait, you can't have missed green coin. Wait, you're talking about green coin, right? Because I mean, I just this second just talked about green coin. So how could you right now be saying you just missed it? But anyway, the bottom line on green coin is they got taken off one of the exchanges. That was screwed up the calculations of the coin market cap. Then so many people complained to coin market cap about their miscalculation of green coin that they stopped tracking it entirely. So now it's stuck at the incredibly low valuation and they're not moving it. So just, as with many things, just wait and see how it turns out. But we'll update that next week. I'm going to talk to Chris, who seems to know about it over the weekend, and we'll hopefully figure it out. So where are we? Oh, okay. So what else is going on? Checking on our portfolios. As I said this morning, and we're already down from this morning, I said, look, forget it. Forget where I said it, but here you go, 19.3. So it's really the same place. But so the long-term portfolio, 19.3. Now it's 19.2. That's just normal daily fluctuation. I would cash out and take the summer off. Okay, that's what I would do. If I was playing this and if it wasn't my job to sit here and talk to you people, I would take the summer off. 20% in May. It's not even May, it's only early May. 4 months. You make 20% a year, it's a good year. Even you look at Berkshire Hathaway, they've had 4, 5, 6 years maybe that they've done more than 20% out of 60. And I know obviously you would say, well, yeah, but had they not had the couple of years where they made the 30 and 40, their whole thing would be less. True, but that's not how we play. We're consistently able to do this, so I don't have the fear of missing anything. My target is 20%. If I hit my target in April, I can quit in April. If it takes me all year to get to 20%, then it's all year. When I only have a 10% year, then maybe next year I won't be happy until I get to 30. But that's a lot easier to do when you recover. But when you have this kind of money in a market that's so uncertain, when you have the president withdrawing from treaties and Iran is now threatening crap and Europe is saying we don't even know if we're going to go along with America anymore, they don't make any sense. You're having a trade war with China. Venezuela's going bankrupt. I mean, there's just so many freaking the president's being indicted. How many things have to go wrong before something actually bothers the market? And so, what do I need the aggravation for? I mean, I'll tell you honestly, keeping the portfolio and running it while it's going down, and balancing it out and so on and so forth is obviously a valuable lesson. But I think the more valuable lessons I'll tell you now, and it's officially, I'm telling you, cash this son of a bitch thing out, take the 20% off the table, and go on vacation. We're not going to make 60% this year. Highly unlikely. And that means anything less than 60% means we're going to have some months we're going to have a quarter that severely underperforms this quarter. Maybe not a pullback, but maybe a very little movement or whatever. And that means it'll either be this quarter or next quarter or the next quarter, one of these 3 quarters. So take one off and hope that's the quarter that it went down. And frankly, if we don't go down, think about this. If we don't go down this quarter, then you have a much more solid upside that you can bank on, because the 200-day moving average will be rocketing up and everything will be rosy looking. So there's very little that you're going to miss by taking the money off the table and going and relaxing and having a life. People really don't appreciate that part of things. I don't know. I'm 55. My mother's friends are dropping dead right and left. Every other day she calls me, who died? I'm like, oh, please. It's like, I really don't want to know. Because and unfortunately, my mother's very popular. Well, she was very popular. She's still pretty popular. But she's always been like a socialite and all that crap. So she's like, she knows everybody. And unfortunately, since she knows everybody, every day somebody dies at this point in her life. She knows hundreds and hundreds of people, and every day one of them dies. It's really sad. So let's say every week somebody dies. It's really, unfortunately, because my mother's 77. So, this is a prime, at this point, the people who are still alive that she knows have a very high probability of not living 5 years. So anyway, it makes me aware of the fact that there are better things to do than sit around staring at the market all day. Especially the lovely spring days we're having here. And there are just other things to do, believe me. So think about that if you've got a good gain in your pocket and and again, not want, everybody wants more money, but if you don't need it, then think about the things you do want, like take a nice trip, do something else, relax. So that's my theory. Anyhow. All right, so this is one of those opportunities that don't come along all the time, because look, usually we almost always make 20% a year, sometimes 40%, but in that range. But we don't usually make it in the first quarter. That's the point. When you make it in the first quarter, that's a real gift, because now you can cash out and coast. If we're only up 5%, if we're in the options opportunity portfolio, I bet we're only up. Well, now we got killed on Helios, so let's see where we are. 6%, so we went down. In the option opportunity portfolio, we're only up 6%. You still got to work. I'm not going to make. I'm going to have to work to make my 20% this year. I'm only on track. Because I took a big hit on Helios and who else? Somebody else. Who's hurting us in the options opportunity? GE. Helios, that's only the new position. The old position took a huge hit, and that's already out. Who's this? Northern Dynasty, another testy that we took. That's actually profitable, even though it's down 17,000 there. All right, so a few companies are hitting this hard there. None of the particularly ones I don't think will come back, but you got to keep your eye on it. And do we cash this out? No, can't cash that out. It's not worth cashing out because we haven't done anything yet. But if you're investing in the long-term portfolio, it's a gold mine. It's a gift. The Butterfly portfolio, 8%, again, on track. And the Butterfly portfolio, by the way, it's almost impossible for it to outperform since we self-hedge everything. So really, it can only be on track. There's virtually no other way for it to go. It's very rare. It's very rare that it goes too high, and very rare it goes too low, because we're selling the crap out of premium on both sides. But that's why I love it. It's the most consistent portfolio we have. It is almost always between 20 to 40% profit every year. Doesn't matter whether the market's up 10% or down 10%. It's going to do the same thing. down, the market's drastically down. Now, that's the only bad thing about butterfly portfolio. If the market is drastically down, we can lose money. If the market's drastically up, we're still only going to make 20 to 40%. It doesn't help us make more money if the market has a huge rally, but if the market has a huge drop, like a 20 more than 20% drop, then we can lose money. But that rarely happens. So, and obviously you can adjust on the fly. On the other hand, we only ever touch this thing like once a month. The money talk portfolio, this one's been around for 6 months and it's up 70%. Again, obviously, it's a good time to cash out and find something else to do. Now, especially with the long-term portfolio, the short-term portfolio is still up 80%, even though the market is rocking. And I said I want to get more hedges. We'll look at that after. So again, you're up $80,000 in this portfolio plus $100,000 in the other portfolio. That's $180,000 from $60,000. So we're from $600,000 start. So we're up 30% in the paired portfolios. That's it. That's a year. Let's go. Okay, who's with me? Jamaica, let's go. Come on. I'm out of here. All right. So anyway, so that's my pitch on that. It's like when you make too much money, you have to have a concept of how much is too much. When you make too much money, you have to say this is kind of silly. What's up with this? You should pay attention to these indexes now. They got bets on them, right? So what? Oh, that's a Nasdaq. Okay. Oh no, Russell losing money. 1,600. Damn it. All right, not good. He's up here. But he's not. I don't want to add yet. What's my average? 99.3. So I have to get up to 16,007 before I really want to add any. And then I can average. Then I can be right on the 1,600 line. Oil is back to down 10. So these two guys are down $90 so far. He's flat. Oh, I was supposed to reduce. I forgot. Oh. That one I was supposed to reduce because I don't have like super faith in it. What am I supposed to do? I'm supposed to buy at 21, right? All right, let's put one in and see what happens. Okay, since the Russell isn't working that well, I'm also going to reduce on the Russell if I get back to my level. Because they're not behaving the way I want them to, so why should I have two open contracts? So, if I'm having a tough time getting where I want to be, I should just go with the one contract and see what happens. There you go. So now I'm up 50. No, I'm up 10 for the day, actually, sorry. And they both just filled. So now I've reduced to one contract. I have a lot less exposure. And now we'll see what happens. And now I can stop paying attention again. But I accomplished my goal. See, when I doubled down, I raised the basis on my shorts, and now it came back down again. I cut, and I'm down back to my original, but at a higher basis than where I first entered. Calvin says, sorry, I was on the phone. Okay. Yeah, we don't want to bother you. All right, THC is going well. Time to take some off the table. Going to 2020. Yeah, THC. I think we're not done with THC, but we kind of, I think we don't care about it anymore at this point. I'm not worried it's going to pull back, and it hasn't. We decided to just hang on to where it is. It blew through our numbers though, so that's gone. CHK. Wow, you guys put so much. Look at Chris Webb. He put so much effort into his question. CHK with a question mark. CHK question mark. And what happened? Nothing. They came up a little bit. What was that, earnings? I didn't read the earnings on that. Yeah, I mean, they were just kind of overbeaten down. I like them still. Our position on CHK is they're not in the OOP, are they? Might be. Yeah. So in the options opportunity portfolio, we have the 3-5 spread for 2020. Again, it's like you guys, yeah. There's 20 months left to this trade. We entered it 2 months ago. 10% of the time has gone by. So we entered on 2/6, and we entered as it was coming down here. Here's February 5th is this one, so that's February 6th. So we entered when it crossed $3, and we said, ooh, that seems like a good spot. I was wrong. It went down to 250 because I can't stop people from panicking. I can call a value, but I can't make people buy. I can't make everybody understand the value, right? So it went down 250, then it went up to 350, but then it settled down at $3, which is where I said it was a good buy. And it stayed at $3, and people could have bought it any time in between now and then. And now 2 months later, here's 1 month. Well, I'm sorry, not 2 months. 1 month, 2 months, 3 months later. It's now moving up, finally. How much of our time? 15% of our time is now put in. We have 85% of our time left to go. We sold the $4 puts because I think that by 2020 we'll be over $4. We bought the 3-5 spread again because I think it might be as high as 5. But I put my foot down at $4, and I think we're certainly going to be over there, so that's why we sold the puts. Now, what happens? We spent net. Well, let's see. We bought these for 180. We sold this for 95. We sold this for 120. Looks like a credit to me. We have a credit of. Oh, I hate math. 85. This brings the average down to 85, and 85 minus 120 is 35. So we have a 35-cent credit at $4. So now we have a $4 put obligation and a 35-cent credit on the spread. So technically, our net is 365. That's our break even. No, actually, I'm sorry, it's not a break even. It's our net. But if it was 365, it would actually be over 3, and we'd make 65 cents on the 3s. So we'd still make 65 cents on the at 365. I guess between 365 and 3 is our break even. So I don't know, whatever that works out to, 350, I guess. Yeah, 350. So our break even is $3.50. It's at $3.33 now, and we have 20 months to go. So I hope that answers CHK question mark. And again, they're long-term plays. It's like we enter them and we expect. If I thought it was going to go rocketing up in 3 months, I would have made a 3-month play. So Brian says Netflix should buy Harmony. Not Harmony, Helio. I call them Harmony, but they're not in any way, shape, or form Harmony. It just seems like Harmony when I look at it. All right, so Netflix should buy Harmony. I say yes, they should. I mean, but they don't. But it would increase their cash burn, so they won't. Conceptually, they should, but it would increase their cash burn, so they won't. Amazon should buy Helios, but that would freak everybody. That would freak out the movie business completely. They would go apeshit. Amazon should buy Helios and buy AMC. Oh, whoa, that would be amazing. That would be incredible. Wow, that would be the ultimate power move by Bezos. Yeah, I should call him. I was talking to his secretary. I was with Bezos' secretary when I was out in wherever the hell I was, in Whistler. We were at this conference, and so I can get in touch with Bezos now. I have her number, so we'll see. But yeah, that's definitely a move I would make. THC. All right, so Doug now wants to know about THC. All right, look, we have we have the 12/20 bull call spread. We sold at $12 puts, and the stock's at 32. Okay, it's not going to go back below 20. So we are 100, not 100%. We are 99.9% sure we're going to collect the full $8 on this spread. How much is the spread now? It is now $21.40, $15.30, so that's $6. So I have a 99.9% chance of getting, let's say it's an 90% chance. I have a 90% chance of getting $2 back on my $6 I currently have. Of making two, and it's not two because I also make this dollar here. It's going to expire worthless. So I'm going to make $3 out of 8. This is 6 minus 1 is 5. So really, I have a net 5 here if I liquidate this, and it's going to be net 8 when it expires. So 3 divided by 5 is 60%. This trade right now will gain 60% in 2 years, 30% a year, if I leave it alone. So what do you want me to do, Doug? Should I get out of the trade? Are you saying, oh my God, only 60% in 2 years? You're a madman. You've got to get out of this trade. No, screw it. It's fine. I'm not in a hurry. I don't have any pressure. I don't see any reason to do anything with it. It's going to make 60% from where it is now. I mean, frankly, it's a good new trade. You know, we should start doing, I'm going to do that. Oh, that's a great idea. We're doing the thing with, what's the name? I can't remember. Trade. Frick. I own this company. We own 10% of the company. I can't think of the name. Trade Exchange. Sorry, there you go. Trade Exchange. So there's a product we're rolling out, Trade Exchange. It's going to allow us to send alerts to people's phones, not just us, but we're in the development team of the product. We're going to send alerts to the phone. Speaking of IPOs, right? And this is something PSW Investments owns. And we started this thing when it was in very early stage development. We started building this product, so it's been a couple of years in the making so far, and we just raised a couple of $1 million to move forward. So we're burning the money just like Helios, but on a much smaller scale. So, because developers, man, are expensive. You ever watch that show Silicon Valley? It's a fantastic show on HBO. And it is funny, though, when you realize how much it is to have these people coding all day long and getting stuff done. Anyway, so the concept is that it's like a top trade alert. We send a top trade alert, goes to your phone, but instead of just getting a little thing that says, look at the trade, it's going to say, here's the trade. And if you click on it, it'll open it up and it'll say, would you like to trade this now? And if you press one button, if you like a trade, just go bip, and it automatically opens up your broker account, puts the trade in for you, and all you got to do is confirm it and go, and you're done. Freaking amazing stuff. And what I'm looking for is nice, easy, surefire trades like that, and this might be a good way to go. Instead of making people have these trades that may or may not work, because it's going to be a less option savvy audience than the people I'm generally talking to now. Because it's going to be a much wider audience we're going to be talking to. Maybe trades like that. It's so deep in the money. It's how can you freaking lose? And you don't have to. Nobody has to worry about it. Nobody has to think about it. You just have $5 that's going to turn into $8 over the course of 2 years, unless a catastrophe happens. But outside of a catastrophe, outside of hitting an iceberg, it's not going to happen. Chris said that was in response to your question of what else had been beaten up in the OOP. Well, we still like CHK. Yeah. CHK it's really not bad. I mean, from January, it's down. No, I see. I don't call that beaten up. I call that a work in progress. It's down practically nothing. I mean, you got minus 15 plus 1,000, say minus 5, minus 275. It's down less than $1,000. But this spread, if it's successful, is a $10,000 spread. So it's down 10% of the spread. I don't consider that a bad thing. Netflix should buy Harmony. We talked about that. THC, we talked about that. Was in response. Okay, now I'm caught up. P. What? Pandora? No thanks. Oh no, that's I see. He's got a little eye thing. I imagine that's a Chris. It's a response. I'm sorry because I'm so behind. It's so behind that there's no continuity to what you guys type and what I see. Any thought on rolling down the Best Buy spread? Not Best Buy. Bed Bath & Beyond. Sorry. In the OOP, we have 10 of the. So it's right here. We have 10 of this, and they're at 16. And should we roll it down with a 1750 put? So did they? I've not been paying attention. I think they had earnings. BBBY. They have their earnings already. Yeah, apparently they did. Bed Bath & Beyond. When do they have them? Oh, wow, that's nasty. Freaking Motley Fool. Bed Bath & Beyond. Motley Fool is just like Seeking Alpha. It's just anybody can write articles in there. You don't have to have any freaking knowledge of anything. Home goods, retailer, blah, blah, blah. Hoping something sticks. Oh, yeah, that's right. That was a while ago. Okay. See, of the $376 million the company spent on capital expenditures last year, half was towards technology projects. And oh my God, they didn't pay off within 12 months. Give me a break. All right. So I still like them, but it's a recovery play. And there's only so many recovery plays you want to be betting on at the same time. And we got plenty. So the question is BBBY. So for one thing, again, it's 2020. And our target on Best Buy, wherever it went, our target on Best Buy is $25. So question number one, is our target now, has it been rendered unrealistic? All right, that's our target, is to get back to here. Is it an unrealistic target? I guess I should try to find the actual number of earnings. Best Buy again. Not Best Buy, Bed Bath & Beyond. Why their margins are going to be strained. Consumer stocks. Their forecast is terrible, time to sell. Wow, somebody at Motley Fool really has it in for these guys, huh? Ah, there you go. That's something more realistic. Okay, Bed Bath & Beyond posted earnings of $141 in the fourth quarter. By the end of 2017, the company had $1.5 billion in share repurchase program. So they're buying back shares. Story continues. I hate that. Decline in margins. Companies repurchasing 8 million shares. By the end of 2017, they have 1.5 billion share repurchases. Blah 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 blah. Williamson, Best Buy's management has announced quarterly dividends. Blah blah blah. Payout ratio. Blah 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 blah. Okay, back. So, bottom line, 141 in fourth quarter, but unfortunately, with a retailer, fourth quarter is usually an outperformer. So now we have to go and look at the actual quarters. First of all, analysts say that they will make, yeah, wow, that's like their whole year's in the fourth quarter. Look at that. That's sad. Here's their earnings history for quarters. So that's normal what they did. They just Wait, EPS, actual EPS, year ago sales. Okay. Revenue estimate, year ago EPS. Okay, so current quarter May. All right, so basically they're showing a slight decline in revenues from three, well, not slight, from 3 to 227, but they're going to earn $2 a share. That's the bottom line. And there's obviously, they made 148 here. They're not, to not make $2, they would have to drop below 20 cents for the next 3 quarters. That's pretty much not going to happen. So they're going to make $2 a share. Shares is $16. That's a PE of 8. All right, so now is 25 reasonable? Yeah, I think it's reasonable that they can get to a 12.5 PE. So the target is extremely realistic. So there's no urgency to adjusting anything. So then the question is whether or not it's worth it to roll down the 1750 calls, which are at the money, BBBY. Do we want to roll the 1750 calls lower? And the answer is, if it's less than 50 cents per dollar to roll, we should probably do it. So, so these look like $3, but these are more than $4. This is $4.20, so it's $1.20 to go down 250. Worth it? Okay, now what's the next one? From 420 to 560 is $1.40 to go down $1.50. I'm sorry, to go down 250. Still kind of worth it. So on the whole, we're going to take these guys at 310, let's say, and roll them to these guys at 560. So it's 260 to roll down to 1250. That's worth it. Why wouldn't we do that? All right, so that's the answer. The logical thing is to do it. So most likely next week when we go over the options opportunity portfolio, that's going to be the call. But that's all you do is you say, is it still a realistic target? Should we change it? Do we have to do anything with it? And you say, no, well, you know what? The target's still good. The 25 target's still good. We're certainly not worried about the 1750 puts at 8 times earnings. So the only issue is, should we or should we not move the 1750 calls? And since we can buy, if you can buy $1 of intrinsic value, of in the money for 50 cents, of course you do that because you're buying $1 for 50 cents. So it's a logical move. See, and Brian says LOL, so he must think that's great. All right. All right, let's see what else. Amazon buys Harmony and AMC and then adds movie passes to Amazon Prime. Ooh, see, Leafs just got the whole thing ironed out. You're gonna come to that meeting with me. we gotta sit down with Bezos. He's hanging out in DC now. We should go down there. Thoughts on PG at this level? Defensive name, blah 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 blah. Look, if they get cheaper, I mean, I like Procter and Gamble. I like all the consumer staples companies that are huge. A lot of them have gotten stupidly cheap. I don't know what PG is exactly, but yeah, I mean, it's silly. It's crazy. They're at a low. I mean, I probably, if you look really long term, they're at a low too. PG. And let's do a shorty thing. And let's look at 5 years and see where we are. Well, you can see it here, actually. What is this? So since 2015, this has been their low. They've had huge support since 2013. So it is the 5-year low you're at now for Procter & Gamble. That seems kind of low. And then if you look at the financials, are the financials at a 5-year low? Well, they are low. They're worse than they were in 2015. They got 5 million less sales. But they've increased their profit. It's interesting. They've increased their income, but they got less sales. So they've gotten more efficient. And isn't that what matters? See, here's the thing. If your top line revenue is going down, but your company's making more money, and it was a huge company, maybe they were smart by trimming like certain product lines that just weren't being as profitable as others. And so maybe they don't need to expand. So, sometimes you can be so big you don't need to expand when you can trim. Like Amazon for a while. Well, not Amazon because they've got stuff. Google's got like 10 different projects going that are costing billions of dollars that they could cut and they would make more money. They get a little less revenue, but they make more money. It's you're not expecting Procter and Gamble to get incredible growth. They sell what they sell. So to trim the product lines to have to ones that are better profitable is a good general move. So anyway, so the bottom line is they're dropping. Well, what's this? 15. Wow. Wait a minute. I was looking at the income from operations. Look at this freaking drop. Wow. Oh, forget that. That doesn't count. Okay, that's a one time. Wow. How do you get a profit from discontinued operation? That's amazing. Most people discontinue operations. It's exactly what I was saying they were doing, but here it's kind of obvious. $5 billion worth of discontinued operations, and that's huge. So anyway, the bottom line is they're significantly making more money, and they're priced at the worst price in 5 years. That's just stupid. So basically, they're on track to make $10 billion, and that's going to be against a $180 billion valuation. So it's not that cheap. It's P's about 18. It's not phenomenal. It's reasonable. It's not terrible. It's not. I mean, it's not great. Forget it's not terrible. It's not great. I wouldn't pay 20 for Procter and Gamble, 20 times earnings. Per share, $4. Again, getting close. 18 times. That checks out. So basically, you're looking at somebody making 18. Making 1/18 their earnings of the stock price. It's only fairly valued. It's not exciting, even though it's 72. So I mean, it's nice. And if you want something long term, safe-ish, at 4%. Gotta remember, at 4% over the course of 10 years, you get 40% of the money you put in back in your pocket. So, all right, let's talk about this. All right, it's important. If I can find the calculator, yes, there's one. Okay. So you put $100 into Procter & Gamble, and 10 years from now, you get $40 worth of dividends over the course of 10 years. All right, so now you got $60 in Procter & Gamble. Or in fact, let's run it out to 15 years, because then you have. No, wait, there's a crossover point. So 13 years. Sorry. 4% times 13 is 52. Yeah, that works out. Okay, so every 13 years, you get half your money back. Let's simplify it, basically. So actually, it's exactly every 12.5 years, right? So every 13 years, you get half your money back. So what happens? So you have Procter & Gamble at 100. 13 years from now, you still have the Procter & Gamble stock plus any appreciation it gets at that time. So assume it keeps up with inflation. So you still have your original 100. But you also have, and dividends keep up with inflation too. So except for obviously you got to pay it over time, so not quite the same. But basically you have another 50 to start buying another stock. Then 13 years later, you'll have that stock, you'll have the Procter & Gamble 100, you'll have this new stock you bought 50, and now the two together are dropping are dropping 75 13 years later. So 26 years from now, you have 100 PG, 50 of the new stock, and 75 more to spend. Now you buy the new stock, boom. All right, so this is year 26. And then in year 39, basically, so 40 years from now, You have the 100 Procter & Gamble, the 50 of the new stock, the 75 of the other last stock you bought. That's 175. They drop very close to 100 to the bottom line. And now you have, so that means that now you're at that moment, in year 40, you now have 400 when you started with 100. So you're guaranteeing yourself by investing in a dividend stock like that and reinvesting the dividends, you're guaranteeing yourself in 40 years you'll have 4 times as much money, including the adjustment for inflation. So 4 times what you have now. So in other words, if I have 100,000 now to retire, and I'm retiring in 40 years, which I wish it was, which hopefully I'm not, but if I have 100,000 now and I'm retiring in 40 years, I will have 400,000 adjusted for inflation 40 years from now. Mindlessly playing that strategy, and that's without options and without anything else. You start applying options and things to that, and I will easily have $1 million. Easily, adjusted for inflation, $1 million. With a simple strategy playing conservatively over 40 years. I can 10 times my money. Okay, I don't understand why people don't do this more often. Yodi does. He holds them as cherry coals and things like that. Yodi, this is, he's living life. He doesn't work at all. he lives in a trailer practically, not a trailer. What do you call it? Whatever you call it, camper. A big RV. He lives in a big, giant luxury RV. He travels all over the place. Has a good old time. And only does his trade once in a while. He uses his little satellite. He uses his satellite and he trades when he feels like it. Because these are easy trades to make, and that's all he does. Because he's a solid, patient, conservative investor. And money, as you roll these things in, and if you do it, especially now, if you do that with $500,000 over 40 years, the money just starts rolling in and rolling in and rolling in. And by the time you're at year 40, don't forget, you're collecting dividends that are 4% of $400,000. You're collecting $16,000. And if you started with 100, that's 16% of what you started with. That's coming in every single year. So if you start with if you start with $500,000, and again adjusted for inflation, $500,000 in 40 years will be paying you, and not the options way, by the way. I'm talking about just flat out dividend way. Will be paying you $100,000 a year while you're retired. Doing it the options way with 10x, you'll probably be taking in, cut $250,000 a year at least. So if you start with $100,000 now, run this strategy and add the options to it, by year 40, you'll be making $250,000 a year adjusted for inflation. So 2.5 times what you have now to invest, you can make down the road. And all it takes is just doing conservative plays like this P&G. And I'll tell you the example of P&G now, so some of you are probably wondering. So look, your timing does not have to be perfect because they're going to pay you 40% of your money back. You got a hell of a lot of cushion. So we buy, not BBY, so PG. So you want to get the dividend, so you buy it for $72.30. You want to be cautious. You sell the $65 calls for I'm going to say $10.30 just to even things out. That's going to drop your basis to 62. 62 called away at 70. If you do get, I'm sorry, 65. If you called away at 65, you're going to make $3. That's 5%. But meanwhile, you're going to collect the dividends. If you get called away at any time, it doesn't matter that you only make 5%. That's a lot more than the 4% dividend, right? I'm talking about doing a totally conservative strategy here. So you're taking a huge insurance hit, a 15% insurance policy on the position. You're laying out, instead of laying out 72, you're laying out $62 for the stock, And if you get called away, it's an instant 5%. 5% is as much as they pay in a whole year. Anytime you're called away, that's a bonus payment you get. If you don't get called away, and you won't because the quarterly payments are only 50 cents or so. So it's nobody's going to pay $3 to call you away when they don't to get a 50-cent premium, a dividend. It makes no sense. So you're probably not going to get called away. You're going to sit and sit and sit on the stock, and when it gets to that time, you're going to roll it. And then you'll just do it again for the next cycle. If you do get called away, who cares? You just buy the stock and sell another call. No hassle. But you got bonus money. The bonus is that $3 spread that you get called away at. Now, you don't just do that, though. Now you sell some puts. So you sell, let's say, the 67.50 puts for $5. It's $4.50. So, well, humor me, $5. So you sell the 67.50 puts for $5. Now your net has dropped from $62 to $57. And if you get called away if you get called away at 65, it's an $8 profit on $52. And that's, I don't know, what is that? That's it's not 10%, it's like 8%. No, wait, 16%. Yeah. So now you can make 16% plus the dividend, still plus the dividend. So you're making 16% plus 4% dividend is 20%. So you're going to make at least 10% or so a year. That's double what the dividend payoff is. And what's your risk? Your risk is that you'll end up owning twice as much Procter & Gamble. If it does drop, you've got your initial batch at 62, and you'll be forced to buy more at 67.50. So your average is going to be 65 on 2 times Procter & Gamble. And then what do? Then you're going to do the same cycle again, knock another $15 off the price, and again, if it goes much lower, you'll get it again. So you might end up owning a lot of Procter & Gamble. But that means, remember the main game plan, though. The game plan is that we do keep buying stocks with reinvesting our dividends and buying more stocks. In this case, you'd be forced to keep buying more Procter & Gamble. You could always not buy it and move to something else if it turns out bad. But you're buying more Procter & Gamble, you just end up owning a lot of Procter & Gamble. Just like if you remember when we were kids, there's always some person that your uncle or your grandparents or they knew somebody that had they had AT&T stock that they had in a drawer for like 40 years and they never thought about it, and now it's worth like $1 million. They go, oh, isn't that nice? We can retire. It's like that. It's not that bad to own a blue chip company for a long period of time. But anyway, that's a very quick conservative example of how we can turn a 4% dividend into a 10% dividend very quickly. And we also reduce your cash outlay significantly from 72 to 52. Also to 57. Right? 72, 62, 56, right? 57, and if you're called away at 65, sorry, it's only an $8. Yeah, I said that though. No, it's $8, yeah. So that I had right. So it's 57. Oh, and that means, I'm sorry, if it's 57 and then that's 67, then it's a little bit lower than 65. Point being, though, that if you can do that easily and that conservatively with a very boring stock like P&G, imagine what you can do with more exciting stocks. And that's what we do. That's all we do. It's very simple. It's not a complicated strategy. The trick is just picking ones that have good option spreads and make sense of the value play going out over time. But you can do this with everything, time after time after time. And if you're making 10%, just this stupid little example, it's so conservative. We don't even do this hardly ever. But just that little conservative thing to do will double your money every 10 years. Not 10 years, sorry, 7 years, I believe it is at 10%. So in 7 years, you will double your money. 14 years, triple, 20 years, double your money in 7 years, you'll double it again to 4 times in 14. And so by year 20, you get another double. You have 8 times your money. So $100,000 in 20 years becomes $800,000 using this strategy. Is that interesting? Is that a time frame you can work with? If you don't have 20 years, I can't help you that much. Then maybe the gambling is for you. But if you've got 20 years and you know that you can make an inflation-adjusted 8 times your money back in 20 years, what else do you need to do? That's a lot of money. That's very close to 100,000 becoming $1 million in 20 years. Just doing something simple like that. All right. 3 says, can you take a look at D? Might make a good income and low risk. I don't like these, unless I'm getting D wrong. D is a minion, right? Yeah. No, I don't like the energy companies. I guarantee you'll see declining revenues. I'll take a look at something though. Financials. Not declining, flat. But it depends what their mix is. So their profile says that it's the production that worries me. It's the power segment because people are just going on solar. Now they're going on solar too, which maybe has a better cost factor for them supplying the energy. But California, they're not in California, but California just mandated all new homes are going to have solar. That's zero customer growth in California for utility companies. That's going to spread all over the country. Zero growth. So new homes never help them. Of their old customer base, more and more and more people will switch off the grid. While it is possible for Dominion to put up huge solar installations and sell people solar-produced energy, the problem is, where's the markup? Because the consumer is still going to be comparing the price to what they could buy themselves. And solar energy is essentially, in a large part, a chip. And since it's a chip, it follows basically Moore's law, and every 10 years, it gets 10 times more powerful for 1/10 the cost. So ultimately, they can't compete. They can't, everyone will go solar. 10 years from now, we will be, well, I don't know, 10 times, but anyway, we'll be double the efficiency and probably 10 times better cost per kilowatt hour with solar. And it won't make sense not to put solar on your home. And they're going to lose customers, and maybe they'll lose 5% a year for the next 20 years after that. So between now and 30 years, I'd say at the most, they will lose probably 60 to 80% of their customer base. I mean, obviously there are people in areas that don't get enough sunlight, that don't face the right way, so on and so forth. But how are they going to be a viable concern if that's the case? Where's the growth story in that? So they just, they deserve to be beaten down. I know they look like values, but there's no growth in these companies at all. It's just not happening. And let's see if we can figure out Dominion. Maybe they have a profile. That'd be useful. Here's Dominion. No profile. Sometimes I think it's when you get a profile, like if I did P&G, like PG, there's a profile, see? And it tells you where their money comes from. Baby and family care, 30%. Fabric care and home care. So laundry. So so laundry is a big. Now PG. You better watch out if somebody invents some better way to do laundry, but that's not happening anytime soon. Beauty products, grooming, healthcare. So that's where they make their money. I don't think it's going to help I put D in here. They just don't have it. There's no report. But those things are really useful when they have them. Give you an idea of how, you gotta know, if you're going to invest in companies, how do they make their money? That's a key question. What happened to the stocks? I forgot to, we haven't even looked. Still there. Ooh, right on the edge there with the Russell. Let's see. Where do we leave off? All right. So I still, I've only got one. Oh, that thing worked. I can't believe it. So I didn't even know that happened. Do I want to add another one? I kind of do. Gosh, how did oil end up? Oil, up 130 bucks. Should we take it? I could have done better if I was paying attention. Oh my God, it hit exactly our spot. And none of you guys mentioned that. Oh, somebody did. AS mentioned it. Very good. Somebody was paying attention. It hit exactly our target. Gotta love that 5% rule. Anyway, all right. Should we take 130 and run? What do you think, guys? I think it should go much lower. I think this is all bullshit. Well, we already know about Iran. We already got the oil news. Nah, I'm going to leave it. I'm greedy. That one I'll be greedy on. The Russell, I'm going to leave the Russell too. I think it's going to pull back. So these guys are even. You know, that was earlier profit. That doesn't count. So those guys are even. These guys are up 100, and these guys are up. I would cut them off at 100. So we got 200 there. And is that all we traded today? I hope it wasn't. Otherwise, I forgot something. All right, so I made 200 today for you guys, so that's good. And we'll see what happens with the Russell. So from now, I'm willing to let this run, but I'll cut it off at 100 if it bounces back. So it's only 30 bucks. So only really about let's say 15 to be the cutoff here. 71.15 would be the stop. On this one though, I'm willing to give it some leeway because I'm really expecting a nice pullback here that could be good for at least a couple $100 bucks. So we'll see what happens. But we got the exact bounce. Now remember though, if it holds the weak retrace line, it's actually a good. It's not a bearish sign. It means they had a normal pullback. That's what a normal pullback is. 20% of the run as a pullback. That's normal. And I'm sorry, very important point. It's 20% of the run to 71.50, which it never actually completed. So it's actually holding the bounce line of the thing it never hit. Means it's very, very likely to retest 71.50. So maybe I shouldn't even play it out. So I'd say 10 should be my stop. I think I should have a very tight stop now. See, I rethought it. This is actually kind of bullish when it holds a phantom bounce. In other words, it never made it 71.50, but it's acting like it did. And the only reason it should be acting like it did is if 71.50 is going to be in play. So I think let's get out of here. Yeah. All right. Done. All right. So officially up 120 on oil. We'll call that a good day. So we made you 200 bucks. I didn't waste your time completely talking about all this crap. And we'll see what happens. And we'll leave the Russell I'm calling open. I say stop over 1,600 is a stop, so you can't lose much more than 20, 30 bucks. But hopefully we hit this red line at 15.95. That'd be a $250 gain. So that's what we're shooting for. And how are we doing time-wise? Oh, got to wrap this up. All right, so that's about it for the day. No worries still. That's not PG works for D exactly what I was looking for. Great. And I rock. Oh, Siri says I rock. That's great. Siri would say I rock too if I tell her. Jackie's caught on to that. She has Siri telling you all kinds of nice things all the time. I don't know how there's apparently some way you can program Siri so like every time you talk to it, it says, "You are so fantastic." It's really kind of funny actually. She has it like always saying like interesting things to her. So anyway, so overall, it's what we thought. Look, it's what we thought. It's an oil-driven rally. The oil's driven off a bad premise. It should realistically go quite a bit lower than this. Below the 71 line, I would play it again with a stop above 71, but at 71.09, I'm not too keen on losing the money I made. So, when you're up 120 bucks, take it and then see what happens. As a gap, the gap of a 10-cent drop, I'm not worried about whether or not I get that 10-cent drop now. So hopefully we do better. I mean, had I caught 71.90, 70.90, I would have been thrilled, but I was busy talking to you guys. So I could have made an extra $100, but I was blabbing away. And don't forget, the NYMEX just closed. And remember I said they should be selling into the NYMEX close? That's exactly what happened. 235 was the NYMEX close, and that was the low for this particular spot. Wait, let's see if we can magnify it there. Well, there you are, 235 right there. Oh, that's not really the low, minus. No, actually, that's not as much as I thought. Oh no, that so we set right here at 20 after 7088. Yeah, right on the dot. I mean, that's exactly what we expected to happen. So you can't complain about that. I mean, and again, I remind you guys, the 5% rule is not TA. It is just math. The math tells us that when you get a run off a consolidation point, you're going to get a retrace of 20% of that run. But you have to find the next consolidation point. So you have to find the logical place where it's going to stop. And you do that either by finding out if it's moving in a 5% increment, the 5% increment for oil, and that means 2.5%, but we had to pick a line. I think we decided to pick 68.50. Is that right? What did we pick? 68 to 71? No. 68.50 to 71.50, right? We decided 68.50 was our base right in this zone over here. And now that's not based on any particular, the consolidation here, it's what the closest line I feel was a reasonable consolidation line. So 68.50. Would I call 68 consolidation? No, it was only really a spike down. Would I call 69 as consolidation? No, because we had significant move below it. Oil moves in 50-cent increments generally, so 68.50 was the closest consolidation point. Moving up then to the next consolidation point, it clearly blew through 71. It consolidated around 71, but the move was probably to 71.50, the intended move where it got rejected. So I'm using that to calculate what. Now, I'm saying, should I be bullish here? Once you go below 70, I recalculate from 68.50 to 70. Then I recalculate, and then I'm going to look for a 50-cent retrace from there. So since, as we were over the line, I can't use 71 to do my calculations because we're over 71. It's kind of silly, right? So I must be using the next line. So if you want to see if it's strong, then we know what it should be holding. But once it goes below 70.90, now that means that it's not really on the way to 71.50. That means it's probably on the way quite a bit lower. And I would very, very much expect to hit the 70 line, the 70.50 line at that point, where you can see there's consolidation again over here. But it's just math. It has nothing to do. I could care less about the chart. The chart just illustrates the math of the thing. But it's all just like learn the concept, and then it's just practice. And once you get it in your head, it's like the times table. It's like once you know what the moves look like, and once you get used to doing the calculations, once that becomes natural to you, then all the other stuff starts making sense really fast because you look at it and you can see the numbers as you're looking at it. It makes perfect sense what the retrace is, how much 20, and you also start getting used to what 20% looks like on a chart. That's also very important. Meanwhile, you got really strong action on the Russell. It's just stepping up, right? Stepping up. So very, very strong action on the index that I still have a short on. But 1600 has got to be some kind of a barrier. So we'll see what happens here. But the S&P is over our number. 84 was where we were looking for. So now we're into the next zone up. And we could get quite a good move. In fact, all right, let's finish it off there. We'll take a look at that if I don't have any other questions. Should we take advantage of buyback the QQQ shorts? Oh, you're right. I should have talked about that. What's the pullback line for RTY? I would say actually had a lot of consolidation here at 80. So we wouldn't be looking for a big pullback. It's only a 20-point run, so 4 points to do it. And like I said, I'd be very happy with $150 on that one. Not a big pullback at all. Should we take advantage of buying the QQQs? Right. Let's look at that. That's important. So Last one we're doing is going to be that. We're going to look at our portfolios again. And in the options opportunity portfolio, are we hedged enough? That's the question. It's a little tricky because we're kind of screwed up because of the stupid Helios losing so much money for the portfolio. Wow, really killed us. We have these SQQQs. Should we spend $1.15 to buy back the $20 calls? No, because we're not even fully covered. So I think maybe we should buy back 10 of those. Yeah, maybe go to a half cover. It's not a big move, but it's a little bit of a move. Now, TZA 12.20, we're nowhere near that. I'm sorry, we have the 10.20 spread. We have the short 12 calls. Okay, here's what we're going to do in this portfolio. We're going to buy back the TZA short 12 calls. It's only $800 to buy those back. That makes us much more bearish because we remove a cover into July that would have stopped us from making more than $2 on the spread. This spread is already in the money. Oh, not there. This spread is already, or it's at the money anyway. The spread's at the money. But the problem is, even if this gains $2, these guys will get more and we'll never be able to use it or do anything with it. We're also only half covered, so this will make us. It'll make us much more bullish. We're limiting the 25 of these to a $2 gain. We're going to take that limit off. That's all we're going to do. But it only costs us $800 to unlimit this gain. And then on what did I say on the other one was SQQ, and we talked about buying, and we'll buy 10 of the short calls back on SQQ. So that'll be enough of an adjustment there. Good. Now, if someone reminds me in chat, it'll be official, but I reserve the right to be confused and change my mind. Because again, I'm getting old. All right. Next, the STP. So the only other place we have we have a hedge in the money talk, but we can't do anything about it, so I'm not on TV. So in the STP, we have just these July DXDs. That's obviously got room to run. We're right at the money on those. So everything up on any down move on the Dow is money for us. Those should be off the table because those are done with. We have 50 short May SQQ calls. We have 80 15. Sorry. So do we buy back these? Yeah, of course we do. Let's take these off the table. It's silly at 3 cents. Well, I don't know. They're going to expire. Forget it. I'm sorry. My bad. Those are going to expire worthless. That'll automatically make us. So next week, these expire, and there's no way it's going to gain $5 by next week. That would be a catastrophe. So these are going to expire, and it'll naturally make us more bearish. TZA, we have the puts. Those are fine. We have nothing else. So probably I'm going to look for another TZA spread. Or maybe we'll do the DXDs in here too. I'll have to decide. But I'm looking at the TZAs or the DXDs, something inexpensive. Oh no, I'm sorry, short-term portfolio. No, for the short-term portfolio, we can afford to spend more money. My mistake. We will add to the TZAs. We'll make a more robust TZA play. Probably if TZA is at 10. It's a 3 times ETF, and that means that if the Russell goes 10% down, it'll go 30% up to 13. This may be the floor on the whole thing, though, for TZA. TZA, let's say it does this by June, and what do we say? 13 would be the target. So if we take the 10, wow, that's so cheap, though. It's not even worth selling the 13 calls. So that's silly. So here's how we're going to end up with the 10s. We're going to just buy the 10s. Because here's the problem. If I go with the 9s, those are kind of expensive. And they are in the money. There's that argument. There's no premium. But what am I going to do? I'm going to sell the 12s when my target is 13? No, that doesn't make any sense. We're giving up $1 for what, a dime? give me $1 in potential gain. Then I say, well, the 13, should I sell them for a dime? No, because if I sell them for a dime, not even that they can get a dime, but if I sell them for a dime, what does that really do? It knocks nothing off my cost, and it makes me inflexible, because if I get a spike in TZA that I would want to sell to, I can't just sell my calls, because now I got these stupid short calls I got to deal with. And I certainly don't want to sell the calls and flip bearish, basically, on TZA right when they're having a rally, which would be why I want to sell the calls in the first place. So that wouldn't make any sense. So that then leaves me saying, well, if I do this, then I'm going to end up having to buy these for 125, 130 with no cover. And I'm like, and then I could lose it if it goes down. So instead of doing that, why don't I just buy these for 60 cents with no cover? They're going to make almost as much money. The delta here is 61. The delta here is 95. So they're going to make 2/3 as much money on the way up. But it's costing half, so I actually make more money percentage-wise on these than I would on the 9s. See? Funny how that works, right? They'll decay faster, but they make up for it like that, and I'm laying out half as much money. And I have, much more flexibility. If I want to later, then roll into like September, and then I would cover or something like that if I turn into a spread. But basically, all I'm going to risk really is 30 cents, because by the time I get to 30 cents, I'll do something about it. And it's very easy to get a pop that's going to make me a lot more than 30 cents. So I at least could end up being $3 for a 5 times return. So, assuming I remember it, those are the adjustments we're going to make. And I'll try to remember it. All right, guys. Oh, 82. Are you freaking kidding me? It's amazing. It'll be so funny if they don't go bankrupt. But unfortunately, it's really disastrous. Wow. HMNY. And there's no news. That's the funniest thing about it. Shares are tanking. Yes, we know that. MoviePass, 31%. Looming cash crunch. It's the same story. Wow. I mean, well, unfortunately, that's the problem, though. Now the story is the crash. See here, now there's a problem. If MoviePass dies, AMC is people are going to say, oh shit, I'm not going to pay that kind of money, and they're going to stop going to the movies. But that's funny. What if the entire movie industry buys MoviePass and sort of self-deals their stuff? That's interesting. They should give you a membership. Let me see. I have a membership. I bet AMC knows what these numbers are. I have an AMC card. I would guess once a month I go to the movies with the kids. So, we'll see. As a rule of thumb, we'll see any IMAX blockbuster, which actually costs double the price. We'll see. Generally, I like to see science fiction or superheroes, something that's worth seeing on a great big screen. Otherwise, I'd rather stay home. I got a perfectly good 80-inch TV at home. So, in fact, I bought my 80-inch TV, justifying it by saying we don't have to go to the movies very often because we have this giant TV at home, and it's true. We never, my kids they have friends over to watch TV in the living room. We have a nice surround sound. We have better food in the movie. We have better seats in the movie. So we go to the movies. We used to go every 2 weeks, and now we go once a month. So I saved half my movie budget by buying the TV. So the TV is way more than paid for itself. Point being, anyway, that so AMC would have to see that also with their numbers, and they've got to say there's a certain number that I'd be willing to pay, which is definitely higher than what MoviePass charges, for my family's entertainment. Like, I would certainly pay $20 a month to go once a week, which would be effectively a half price off the ordinary. But then I would pay the upcharge to go see IMAX. So there's definitely a way to do this in a better manner than they're doing it now. For a normal family, I would think that would be plenty. If I pay $20 a month to see one movie a week, which I'm not even going to do, but just to know I could do it, and my family, let's say, for let's say let's say my family plan was $100 a month. 50, but let's say 50, yeah, 50, but 100 a month maybe I would pay, like cable. Because I spend $100 pretty much when I go one time. So 100 a month seems like a great deal. And again, I would go more often, but not so much more often than it would kill AMC. It'd be like giving me a 50% discount, but then I'm going to buy popcorn and upgrade to IMAX and all the other crap. And they could hit you with stuff all the time. Like, would you like to get this? Would you like the seating? Would you like? They could do it and say you don't get you don't get reserved seating. But then if you want reserved seating for $2, you get reserved seating, and they can just nickel and dime until they get their money back. Kind of like those free games that charge you for all kinds of stuff. So anyway, I can see a lot of ways for this to work, but unfortunately, nobody can see anything but it going bankrupt right now, and it can become a self-fulfilling prophecy. Until they raise money or get rescued, this thing can go down and down and down, unfortunately. So we'll see what happens. All right. Sorry to note a sad note, but sad note it is. And we're going to wrap it up now because I got to go. Let's see. Ooh, slides? Wait a minute. How do you do this? Is this from their slide presentation? All right, let's check this out. Oh, slides too blind. Though they had a slideshow or something. Yeah, that's news. I mean, for them, that's well, it is news. I care. But nothing new is happening. It's just the panic. You got to let the panic is panic. You just got to let it go until it subsides. We jumped in a little too early and we added to our position, but we'll see if a dollar is the right place or not. I thought a dollar was going to hold, but apparently it's not holding. All right. Anyway, have a lovely day, everybody. See you next week. Appreciate it. Take care.